Halt the chart. Forget the spot price. Cut the noise. Watch the candle itself. That violent spike up isn't a normal market action. It isn't organic buying pressure. It signals something broke inside the system. Silver didn't climb to $83. It teleported there, and markets only move like that when liquidity dries up and algorithms take full control. 1 minute silver sat under 80. The next it wicked past 83, and before the market could breathe, they tamped it back down. A $9 swing in one session rattles even veteran stackers. If you're new, your gut screams fear. You think the rally's dead. You figure smart money sold the top and left you holding the bag. That panic is exactly what this volatility was engineered to manufacture. Silverbacks see it differently. If you stacked through 1980 or survived the 2011 raids, you know this setup. This wasn't a collapse. It was a stop hunt, a calculated move in a thin holiday market when volume is low and the order book is weak. Ghost week means liquidity dries up, and when liquidity vanishes, prices can be pushed anywhere for a brief moment. This wasn't true price discovery. It was about flushing out leverage. The algos forced spot higher to bait late buyers, then ripped it lower to trigger forced selling. Fear was the weapon, volatility was the tool, and weak hands were the target. In this emergency breakdown, we'll expose what really happened beneath that candle. We'll show why the paper market acted like a rigged casino, while the physical market barely flinched. The screens looked chaotic, but the foundation did not crack. This wasn't the end of the rally. It was the opening shakeout. If you're still calm after hearing this, type 1 in the comments. If you want the rest of the analysis, subscribe now, because the next chapter explains exactly who got trapped, who stepped in to buy, and why this shakeout strengthened the trend. To see why the price smashed down so hard, ask one simple question. Who bought at 83? It wasn't patient stackers. It wasn't the whales. It wasn't those who stacked quietly at 30, 40, or 50. The buyers at 83 were the late FOMO crowd, the chasers, traders who saw a vertical moonshot on Sunday night and convinced themselves that speed means safety. Most of that cash was leveraged, 10 times, sometimes more. Leverage always leaves a fingerprint. When traders buy late on margin, they protect themselves with stop losses. These stops aren't hidden. They're mapped, clustered, and statistically predictable. The market knows where they are because human behavior never really changes. When silver broke 80, most stops sat just below 75. That level was a magnet. Once spot began to roll over, the selling wasn't emotional at first. It was mechanical. Huge paper blocks hit the market at the highs, pushing price into thin liquidity. As spot slid through 79 and 78, nothing dramatic happened. But once it touched the stop zone, the cascade began. Thousands of auto sell orders fired at once. Margin calls followed instantly. Positions were liquidated not by choice, but by force. That is why the drop felt like a waterfall. It wasn't sellers changing their minds. It was leverage being wiped out. The market was cleansing itself. While that panic unfolded on the screen, someone else was waiting. The same whales who sold into the spike were positioned to buy back lower. They didn't chase the strength. They harvested weakness. This is how leverage gets rinsed out of the system. It isn't fair, but it is how unstable markets reset before they move again. What matters is what happened next. Spot didn't keep falling. It hit the mid-70s and demand appeared instantly. That demand was real. It was decisive. It absorbed the forced selling and pushed price back higher. That tells you the drop wasn't a rejection of silver. It was a transfer of ownership. The gamblers were flushed. The market survived. Now look at the candle again, but through a technical lens. What printed is a shooting star, sometimes called a high wave candle, a small body with a long upper wick. To most traders, that wick looks like failure. It looks like rejection. The market tried to go higher and got tamped back down. And in isolation, that interpretation makes sense. But context changes everything. A shooting star at the end of a trend is dangerous. But a shooting star at the start of a breakout formed in a low-volume holiday vacuum tells a different story. It signals excess speed, not structural weakness. The market moved too far too fast and needed to release pressure. That wick is the release valve. Despite the violent tamp from the highs, the close is the data that matters. Ignore the spike, ignore the panic. Compare where we are now to last week. Silver closed the prior week in the low 70s. After all the chaos, it is still trading near the high 70s. That isn't failure, that is strength disguised as disorder. What you'll see next isn't another vertical move. It is digestion. Price needs time to process a $9 range. Expect consolidation. Expect frustration. Silver may drift between 75 and 80, chopping around to destroy momentum traders and option buyers. This isn't an accident. Sideways markets exist to exhaust impatience. The key level has already revealed itself. The bounce hit almost exactly where last week's breakout began. Old resistance turned into new support, and it held the first test. That is textbook behavior. It confirms buyers are defending higher ground. This phase feels boring compared to the spike, but boredom is good. It allows moving averages to catch up. It allows volatility to compress, and compression, not excitement, is what fuels the next leg up. The market isn't weak right now, it is catching its breath. While silver thrashed violently, something else quietly sent a message. Gold barely moved. It dipped, slightly held ground, and remained anchored near all-time highs. That contrast matters. In real breakdowns, correlations rise. Everything sells off together. That didn't happen here. Gold stayed calm, and calm assets don't coexist with broken systems. Gold is the anchor in the metals complex. When it holds, it tells you the monetary backdrop hasn't changed. Debt is excessive. Confidence in fiat systems is fragile. Nothing about today resolved those issues. Silver just ran ahead of itself as always. It's the high beta sibling. It overshoots on the way up and overreacts on the way down. This is the cost of entry. Silver doesn't offer smooth trends. It offers acceleration. If you want the upside, you accept the turbulence. That turbulence taxes leverage and rewards patience. Physical stackers knew this instantly. They didn't panic. They didn't rush to sell. An ounce remained an ounce regardless of what flashed on the screen for a few minutes. This brings us to the main divergence. While paper price collapsed, the physical market didn't follow. Dealers didn't slash prices, premiums didn't vanish. In some cases, they widened. That behavior tells you everything. Physical sellers weren't convinced the move was real. When paper prices swing wildly, dealers protect inventory. They know the volatility is artificial and temporary. Selling physical metal into that chaos is a guaranteed way to lose money. So they step back. Supply tightens. That creates a hard floor. This is why paper crashes don't always translate into real-world discounts. The drop existed on screens, not on the street. The disconnect isn't a flaw. It is a signal. It tells you which market is unstable and which one is grounded. Volatility shook the roof. The foundation stayed intact. The next piece is volume, or rather the lack of it. Ghost Week strips market depth. When traders step away for holidays, the order book becomes hollow. Prices don't move smoothly in hollow markets. They fall through air pockets until they hit real demand. That's exactly what happened during the drop. No buyers sat in the high 70s gap. Price didn't slide, it fell. When it hit the prior breakout zone, demand finally appeared. The reaction was aggressive. This wasn't retail buying. This was industrial and institutional interest stepping in where it was always planned. Large industrial users don't chase price. They wait. When silver spiked above 80, it created anxiety for procurement desks. But when price snapped back into the mid-70s, it became an opportunity. Hedging programs activated, buy orders executed, paper selling was absorbed and converted into physical demand. That is why the bounce was sharp. The market found its floor because that floor mattered. Old resistance at 75 became new support, and it was defended on the first test. This isn't random. It is structural. What you saw was a transfer. Speculators were flushed. Diamond hands replaced them. This is how trends mature. Weak hands are replaced by committed ones. Each cycle raises the floor. We are seeing a solid stair-step pattern form. Last month, support sat near 65. This week, that floor looks closer to 75. Higher lows might feel boring now, but they build the foundation for the massive moves. The volatility was deafening, but the signal was faint. That signal confirms the bid is legitimate. Now we must discuss the volatility tax, because volatility is never just random punishment. It is actually a fee charged specifically to leverage. If you were trading futures options or margin during this swing, you paid that fee in real time. Stops hit automatically. Margin calls came without warning. Positions liquidated, not because the thesis was wrong, but because the structure was too fragile. That pain was engineered. It is how the market enforces discipline. Physical stackers paid zero. They didn't need to act. They didn't have to decide. An ounce is still an ounce. What they gained was pure clarity. For a second, the market showed its hand. The spike past 80 wasn't noise. It was a preview. It revealed where the price heads when the pressure is finally released, even just for a moment. This event was a stress test of your conviction. When the price ripped higher, it did so easily. When it fell, it took force, huge size, and coordination. That asymmetry is key. It reveals where the resistance truly lies. Energy always builds in the direction that needs the least effort. Simultaneously, the open interest was reset. The market had gotten crowded with leveraged longs. The boat tipped, and that excess weight was tossed overboard. Now the ship is stable again. Clean decks will invite much stronger capital. This reset is very constructive. If silver had marched straight toward triple digits without interruption, the eventual correction would have been violent and destructive. By flushing leverage early, the market reduced systemic risk and really extended the life of the trend. Volatility feels like chaos in the moment, but in trending markets, it is just maintenance. It tightens loose bolts, removes excess pressure, and preps the structure for the heavier loads ahead. The move looked quite brutal, but the adjustment was necessary. Now pull your attention back and look at the bigger signal the market just sent. This move did not come from the outside. There was no interest rate shock, no currency collapse, no geopolitical headline that rewrote the rules overnight. The dollar stayed relatively calm. Bonds did not implode. Equity markets did not signal systemic fear. That tells us something critical. This was not a macro event. It was purely a structural purge. When markets break because fundamentals change, they stay broken. When they break because positioning becomes unstable, they rebound quickly. What you witnessed was a failure caused by excess weight and not a loss of belief. The longs were not wrong. They were simply overextended. The market did exactly what it always does in that situation. It forced them out. This is why the setup for January actually improves after a move like this. Leverage was flushed out. Open interest has been reduced. Weak hands have been removed. The path forward is much cleaner. Institutional capital does not want to buy chaos at the highs. It wants to buy resilience after stress. A reset near 75 is far more attractive than an untested vertical spike above 80. Big money waits for confirmation. Violent shakeouts provide that confirmation. They prove that price can absorb pressure and still hold elevated ground. That resilience is the signal long-term capital always responds to. Pay attention to the psychology shift. Just days ago, silver at 65 felt expensive. Today, silver near 78 feels frustrating. That reversal in perception is how bull markets mature. Expectations outrun price, and that creates massive fuel. This was not a warning shot. It was a cleansing. And markets that have been cleansed tend to move with far more force in the direction that remains intact. Now we need to confront the part of this move that unsettles most traders, the long upper wick. That wick looks brutal. It feels like rejection, like the market slammed the door at 83 and shoved silver back down in seconds. Traditional technical analysis will label this as resistance, and in the short term, that is accurate. Markets remember pain, and pain creates new supply. Traders who bought near the top and survived the drop are now emotionally trapped. When price approaches that level again, many of them will sell just to escape at break-even. That selling pressure does not disappear overnight. It has to be absorbed. This is why 83 will not fall easily on the next attempt. The market needs more time to process what happened. Expect a grind, not fireworks. Expect silver to move sideways between 75 and 80 churning in a way that feels pointless and exhausting. This phase is designed to break patience, not portfolios. Moving averages need time to rise. Volatility needs time to contract. Energy needs time to rebuild right beneath the surface. This is the most psychologically difficult part of a bull market. The excitement fades, the headlines quiet down, and doubt creeps back in. Many investors exit here mistaking consolidation for failure. History shows the opposite. Strong trends pause before they really accelerate. The wick did not kill the move. It mapped the battlefield. It showed exactly where sellers appeared and exactly where buyers defended. That information reduces uncertainty, and reduced uncertainty leads to faster future price moves. Most importantly, the lows held. Buyers protected higher ground. Conviction did not break. The next breakout will not be loud. It will come when boredom replaces fear and when attention finally disappears. That is exactly when markets strike. Now let's bring time back into the equation because timing is everything at this stage of a trend. We are approaching a critical window, the end of the month and the end of the year. These closes matter far more than any intraday spike or collapse. Daily candles scare people. Monthly candles move the institutions. If silver holds above 75 into the monthly close, it will register the highest monthly closing price in history. Read that again slowly. Even with all the chaos, even with a $9 intraday collapse, the market is still on track to print a historic signal. That single data point outweighs every emotional reaction seen today. Large funds do not care about wicks. They care about closes. They care about trends that survive stress. A strong monthly close tells pension funds, endowments, and asset allocators that silver is no longer a speculative sideshow. It becomes a legitimate allocation. That is when the real size enters the market. This is also why the violence likely happened now and not later. If leverage had not been flushed before year-end, it would have created instability during January inflows. The market preemptively cleaned itself. That makes the runway safer for larger capital to land on. Understand the psychology here. A close near 78 feels disappointing because you briefly saw 83. But zoom out 1 month. Not long ago, 78 sounded impossible. This shift in expectations is how wealth is really built quietly, not loudly. The battle into the close is simple. Bulls defend 75, bears try to break it. As long as price holds above that level, the breakout remains intact regardless of how ugly the path now looks. This is not about predicting the next dollar. It is about respecting the signal the market is preparing to print. And that signal, if it holds, changes the game going forward now. We have reached the final chapter, and this is where perspective matters more than prediction. What happened today was not comfortable. But bull markets are not built on comfort. They are built on survival. If you made it through a $9 swing without panic selling, you have passed the first real test of this cycle. The final verdict on that shooting star candle is simple. Context decides meaning. In exhausted markets, it marks a top. In newly awakened markets, especially during thin holiday liquidity, it marks a reset. What we witnessed was not a reversal. It was a liquidity test. The market tested 83 and found sellers. It tested the mid-70s and found aggressive buyers. Now it knows the range, and knowing the range is how trends do mature. Here is the strategic takeaway. First, audit your exposure. If today made you physically uncomfortable, you were carrying too much leverage. Reduce risk where necessary so volatility cannot force your hand. Strong positions are positions you can hold through noise. Second, respect the 75 level. That is the line that defines the breakout. As long as it holds, the larger trend remains intact. Third, stop staring at intraday candles. The next few sessions may be dull, choppy, and frustrating. That is not danger. That is just preparation. The real opportunity lies ahead. January brings fresh capital, rebalanced portfolios, and institutions that care about monthly and yearly signals, not emotional spikes. The market just removed weak ownership and raised the floor. That combination is very powerful. Remember this, the most profitable trends feel the most uncomfortable at the beginning. You are not late. You are early in a market that is transitioning from ignored to unavoidable. Today's volatility was just the price of admission. If this analysis helped you stay grounded, make sure you subscribe, like, and share this video so more people can see through the noise. And tell me in the comments how you handled today's move. Staying calm is not easy, but it is how capital is built up. The rug pull failed, the trend survived, and the next chapter of this market is just getting started now.